The price on your screen doesn't matter. Not today, not anymore. Because while everyone was staring at $79 silver, something far more important happened behind the scenes. This wasn't a price move, it was a signal that the system everyone trusted, the charts, the paper contracts, the promises, is starting to fracture. When one of the most powerful industrial figures on Earth publicly acknowledges a silver shortage, it isn't commentary, it's a warning. Because silver isn't a trade for them, it's oxygen, it powers electric vehicles, it runs solar panels. It sits inside every high-efficiency system that defines the modern economy. And when the people who need the metal start questioning availability, not price, the game changes. This is the moment the market shifts from speculation to survival, from bets to battles. What you're watching isn't a rally. It's a quiet evacuation from paper promises into physical reality, because somewhere between Wall Street spreadsheets and factory assembly lines, a realization is spreading. You can't print conductivity, you can't hedge an empty shelf, and when the metal stops moving, the money follows. And what happens next is not priced in. Forget the number on the screen. Erase it from your mind, because $79 silver was never the story, it was the distraction. The real event happened quietly, without a bell, without a headline ticker screaming breaking news, and that's what makes it dangerous. Markets are trained to worship price. Green candles mean safety, red candles mean fear. But history shows us something unsettling. The most important moments never announce themselves with price first, they announce themselves with behavior. And today, behavior changed. When silver crossed $79, traders celebrated. Algorithms fought for fractions of a cent. Charts lit up like a scoreboard. But while everyone stared at the score, the stadium was already on fire. This pattern is well documented in financial history. In 1971, gold didn't explode first. Governments started hoarding quietly. Then Nixon closed the gold window. In 2008, home prices didn't collapse first. Interbank lending froze. Then Lehman fell. Signals always precede price. Physicist Richard Feynman once said, "Nature cannot be fooled." Markets are the same. You can manipulate numbers. You can suppress charts, but you cannot fake physical stress. And today, physical stress showed itself. Silver is not just an investment metal. It is element 47 on the periodic table, the most electrically conductive metal known to science. Measured in Siemens per meter, silver outperforms copper, outperforms gold, outperforms everything. That isn't opinion, that's physics. And physics doesn't negotiate with markets. When availability tightens, systems fail silently at first. Engineers notice before traders. Procurement officers panic before analysts. Factories feel pain before charts react. This is exactly what we are witnessing. The price moved, yes. But the reaction mattered more. Delivery times stretched, inventories thinned, premiums crept higher. These are early warning tremors. Seismologists don't wait for buildings to fall, they watch the microquakes. Markets work the same way. According to metallurgical research published by the Silver Institute, global above-ground silver stocks are finite and shrinking. Once drawn down, they cannot be rebuilt quickly. New silver production takes 5 to 10 years to permit billions in capital, stable energy, and water access, none of which exist in abundance today. So when silver moves sharply, the question isn't how high, the question is why now? And the answer isn't speculation. It's stress accumulation finally crossing a threshold. Think of a metal beam under pressure. At first nothing happens, then microfractures form, then suddenly failure. No warning, no negotiation. $79 wasn't the breakout. It was the audible crack. And once you hear it, there's no going back. Because markets can lie, charts can lie. But when physical systems reach their limit, the signal has already been sent. And what follows next is not volatility. It's inevitability. The game has changed. The financial war, over. The industrial war, just beginning. This isn't about hedge funds. It isn't about paper contracts. It isn't about algorithmic trading. This is real metal, real factories, real production. And when industrial demand hits, the rules are different. Tesla, Apple, Samsung, the giants of modern technology, they don't buy silver to speculate. They buy it to survive. Because silver isn't just shiny. It is the heartbeat of high-tech industry. Every solar panel, every EV battery, every 5G tower relies on it. Silver's conductivity isn't optional. It is physics. Measured in 63 million Siemens per meter, it cannot be substituted without efficiency loss. And here's the problem. The metal is running out. Not in theory, not in the charts, in reality, on the shelves. Physically. Tesla doesn't write checks for missing silver. If the metal doesn't arrive, assembly lines stop. Cars remain unsold. Solar panels remain uninstalled. Revenue disappears. Empire wobbles. This is what makes industrial demand explosive. Unlike banks, who can settle on paper, industrial users must hold the physical metal. No substitutes, no derivatives, no margin calls. And when the largest industrial consumer on Earth signals a shortage, everyone else panics. Samsung doubles its order. Apple triples it. Battery manufacturers in Korea secure warehouses of silver. It's a chain reaction, a hoarding cycle, a race for survival. Historically, we've seen this pattern before. During the 1973 oil crisis, countries stockpiled crude, sending prices skyrocketing. During the rare earths shortage in 2010, manufacturers rushed to secure strategic minerals, leaving the rest of the world scrambling. Now imagine this with 1.24 billion ounces of annual silver demand versus 1.01 billion ounces of supply, a deficit of 250 million ounces, enough to freeze factories, enough to disrupt global production. And it's not just numbers, it's timing. China, controlling 60 to 70% of refined silver, is about to enforce export restrictions, a physical blockade. The floodgates close. Western industrial users are trapped. They cannot import. They cannot substitute. They can only scramble and buy at any cost. Premiums explode. Orders sweep every available ounce. 79? A bargain. 100? The floor. $200? Possible if panic accelerates. This is why industrial war isn't a metaphor. It is literal. Factories, supply chains, and product launches hang in the balance. Algorithms can predict price, but they cannot manufacture silver. As the countdown ticks toward January 1st, 2026, the day the Chinese export licensing system kicks in, the pressure builds like magma beneath a volcano. And when the first factories halt, the ripple will spread. Not through Wall Street, through the real economy, through every product that powers the modern world. Everything changes when China acts. Because in the global silver market, China isn't just a player. It is the game. 60 to 70%. That's the share of global refined silver they control. Every ounce mined in Mexico, Peru, or Bolivia, it often flows through Chinese smelters before it reaches the West. Now, imagine the gates closing. January 1st, 2026, a date that will echo across factories worldwide. The Chinese Communist Party is implementing a new silver export licensing system. On paper, it looks bureaucratic. In reality, a blockade. Only companies that meet two criteria can export: annual production of at least 80 tons, established credit lines of $30 million USD. Those numbers aren't arbitrary. They are a guillotine for smaller refineries and trading houses. Hundreds of mid-sized exporters, once the backbone of global silver supply, are instantly disqualified. No licenses, no exports, no exceptions. Where does their silver go? Inside China, flooding local markets, stocking BYD, KTL, and other industrial giants, a strategic lockdown. Think back to rare earth metals a decade ago. China tightened quotas, crushed foreign competition, and forced tech companies to relocate production. Now, silver is next. The implications are staggering. Western manufacturers, Apple, Tesla, Samsung, cannot call a refinery in Shanghai and expect delivery. The metal is trapped. Physically, legally, politically. The math is simple. Global demand, 1.24 billion ounces. Global supply, 1.1 billion ounces. Deficit, 250 million ounces. China's move amplifies that gap. The Western market becomes an island of scarcity. Supply is concentrated in China. Demand is concentrated in the West. Panic becomes inevitable. And this isn't theoretical. Inventory data confirms it. Registered silver in COMEX vaults is down 70% since 2020. London vaults, 40% depletion. The buffer is gone. Elon Musk sees this. He knows the stakes. Tesla is effectively naked short on physical silver. A halted supply chain isn't a loss on paper. It's a stalled empire. As the countdown ticks closer, the psychological effect intensifies. CEOs are scrambling. Orders double, orders triple, warehouses fill, premiums spike, $79 an ounce, already too low. 100? Conservative? 200? Within reach if the scramble accelerates. This is geopolitical resource warfare masquerading as regulation. China isn't raising prices. They're controlling access, turning physical silver into a privilege, not a right. Every decision now is a race against the clock. Every ounce becomes a lifeline for production. Every delayed shipment risks factory shutdowns across the Western world. The industrial war has now become a battle for survival, and China holds the gate. Forget $79. That number is history, a relic of the paper market. The industrial world sees reality differently. Tesla, Apple, Samsung, they don't care about price swings. They care about delivery. A $50,000 EV uses less than $200 of silver, but without it, the car doesn't move. A solar roof without silver? No electricity. This is where the floor comes from, the industrial floor, the price at which factories can continue. Not traders, not speculators, not hedge funds. Silver consumed by EVs and solar panels. 50-60% of production global structural deficit. 230 million ounces. COMEX paper to physical ratio, 356. 1. The math is simple. When the physical metal is needed, the price must reflect scarcity, 79. A discount, 100. The new baseline. Tesla's supply chain doesn't negotiate. Musk's tweet, "This is not good," was a warning flare. Factories stop without metal, stocks fall, markets panic. The industrial buyer is price inelastic. China's export blockade makes it worse. Western manufacturers can no longer source from the world's largest refinery network. Supply is trapped. Demand is urgent. Price spikes are inevitable. The paper market still pretends silver is abundant. Futures contracts trade, algorithms spin, screens flicker $79. But in Shanghai, physical silver trades 80 bontos. The arbitrage is dead. The gap signals the true cost of survival. Now, imagine this. COMEX vaults, almost empty retail shelves lagging. Industrial demand accelerating, export bans tightening. $100 isn't speculation. It's industrial necessity. It is mathematical certainty. It is the cost of failure. Every attempt to suppress the price, paper shorts, derivative hedges, algorithmic manipulations, fails. You cannot print conductivity. You cannot print a Tesla battery. You cannot print a solar panel. The physical shortage dictates the price. The countdown is relentless. January 1st, 2026, the Chinese export license marks the point of no return. The global silver market bifurcates. East, premium prices, secure supply. West, desperate scramble, dwindling reserves. The $100 floor is not a ceiling. It is the baseline for survival. Every ounce above that, a signal of industrial panic. Every delayed shipment, a countdown to production shutdown. This is why $100 is the floor, the number the market cannot ignore, the number that guarantees factories keep running, the number that turns paper promises into physical reality. For 5 years, the world has been consuming more silver than it produces. This isn't a fluke. It isn't a shipping delay or a temporary bottleneck. It is geology and physics playing their relentless game. Global silver demand in 2025, 1.24 billion ounces. Global mining supply, 1.01 billion ounces. Gap, 230 million ounces. A deficit carved in raw numbers. Where does the extra silver come from? From above-ground stockpiles, vaults in New York and London, recycling operations. But even the largest reserves are finite. London vaults down towards 40% since 2020. Registered inventories at COMEX down 70% usable silver, 30-45 days in key Western regions. This is barely a buffer. One delayed shipment, one supply chain hiccup. The industrial world stops. Why does this matter? Because silver isn't just a commodity anymore. It is the lifeblood of high-tech industry. Tesla batteries need silver contacts. Solar panels need silver paste for conductivity. 5G towers, advanced electronics, all depend on it. Physics doesn't negotiate. Good enough is not enough. Silver is indispensable. Wall Street assumes a substitute exists. Copper, aluminum, palladium, they say. They are wrong. Electrical conductivity of silver, 63x106 SM copper, 59x106 SM gold, 45x106 SM. Every replacement lowers efficiency. Every substitution costs innovation. Every ounce matters. Meanwhile, the paper market pretends abundance. COMEX paper to physical ratio, 356.1, futures, ETFs, shorts, all playing a game of musical chairs. But the deficit is real. It is structural. And when reality hits, the paper illusions collapse. The industrial world is waking up. Tesla, Apple, Samsung, they see the shortage. They don't care about the number on the screen. They care about metal in hand. This deficit isn't just local. It's global, and it's accelerating. China controls 60 to 70% of refined silver. When Beijing closes the export gates, the West loses access to 40-50% of supply overnight. The countdown is ticking, January 1st, 2026. By then, the deficit isn't a statistic. It becomes a full-blown industrial crisis. For the first time in decades, demand cannot wait. Supply cannot be printed. The world cannot ignore the structural deficit. Step into a warehouse in New York. On the table sits a single 1-ounce silver coin. Outside, 356 people wait, each holding a piece of paper. Each paper says, "I own this silver." They paid for it. They believe it. Banks assure them it's there. For 40 years, this Ponzi-like choreography worked. Hedge funds traded paper endlessly. High-frequency traders swapped it back and forth. The music never stopped. The system looked solvent, but now the music has stopped. Elon Musk enters, metaphorically. He tweets, "This is not good." Industrial giants like Tesla, Apple, Samsung scramble. They don't want paper. They want physical silver, delivered yesterday. Suddenly, 356 claims collide with one coin. One person gets the silver. 355 are left with nothing. Their paper becomes worthless, cashed out at a number detached from reality. This is the death of paper, a systemic illusion built on trust and leverage, shattering in real time. Why does this happen now? Because industrial demand has eclipsed supply. Because China's export clampdown is removing half the world's refined silver from circulation. Because Tesla cannot print silver. Because physics doesn't negotiate. The COMEX, London vaults, ETFs, all pretend abundance. They trade hundreds of times more paper than physical silver exists. Paper to physical ratio, 356.1, a mathematical house of cards. When the industrial giants demand real metal, the illusion collapses instantly. Collateral evaporates. Margin calls spike. Banks scramble. Liquidity tightens. The entire financial system quivers. And here's the terrifying part. The paper market still sets the screen price. $79, but that's fiction. The street price, where silver actually moves, is much higher. Shanghai, 80-plusers. Physical demand is outpacing paper contracts. The arbitrage mechanism is dead. The Fed's $17 billion repo bailout? A desperate attempt to patch paper illusions. It doesn't create metal, it just keeps the banks alive for another day. Meanwhile, industrial buyers ignore the paper, paying any price for real silver. The psychological shift is profound. Speculation becomes survival. Short-term profit gives way to physical possession. Paper contracts lose authority. Reality, the physical deficit, dictates the market. We are witnessing the final collapse of the paper market facade. A century of financial legerdemain meets industrial necessity. The countdown is ticking. The screen shows $79, but that number is a lie. It's the paper market whispering sweet illusions. Behind the curtain, the real price is surging. Industrial giants are no longer price sensitive. Tesla, Apple, Samsung, they need silver to survive. One Model Y battery, one solar panel, one iPhone chip. Without silver, it doesn't exist. The cost? A rounding error. The urgency? Existential. Step back and look at the physics. Silver is the most electrically conductive metal on Earth. It conducts better than copper, better than gold. Thermal conductivity, highest. Optical reflectivity, maximum. For EVs, solar, AI chips, no substitute works. Copper fails. Aluminum fails. Palladium fails. Only silver delivers perfection. The industrial war has created inelastic demand. No longer does a price spike slow orders. It accelerates them. Procurement officers call refiners, double it, triple it, store it, now. Combine this with China's export clampdown. Roughly 60 to 70% of global refined silver is now inaccessible to the West. Physical supply is collapsing. The paper market cannot catch up. Screen prices are irrelevant. The industrial floor has been set. Mathematics decides the floor, not charts. Global deficit, 1.24 billion ounces demanded versus 1.01 billion ounces mined. Shortfall, 230 million ounces. Add China locking exports, deficit expands. Add Musk's panic buying and Samsung's stockpiling, the physical metal evaporates. $100 is no longer speculative. It's industrial reality. The cost to halt production of EVs, solar panels, and electronics is astronomical. Pay $100 per ounce? Yes. Miss an order? Disaster. This is the new baseline. $100 sets the industrial floor. Prices may spike higher. The Fed's $17 billion bailout, it cannot stop physics. The paper market? Already collapsing under 356.1 leverage. The narrative is clear. Screen prices, dogma illusion. Physical metal mirrors power. Industrial demand mirrors invincible. And here's the haunting part. If you think you can wait for a dip, think again. Retail shelves will empty. Delivery queues are stretching months ahead. The $100 floor isn't a ceiling. It's the baseline of survival. Every ounce above $100 is a premium for continuity, production, and future tech. Every delayed shipment is a countdown to manufacturing shutdown. The market has already begun pricing in scarcity, not speculation. We've crossed a Rubicon. Paper is dead. Physical rules. Industrial necessity dominates. The Fed, the banks, the futures traders, they cannot stop it. The $100 floor is the new law. Hit subscribe to stay ahead of the industrial scramble. Smash that like if you want real insights, not the paper illusions the media sells. Share this video, because everyone needs to understand why $100 silver is just the beginning. Comment below. What would you do if you had the chance to secure physical silver before the doors close? Time is ticking. The countdown has begun.